Hi, welcome back. In the last few sessions, we've looked at patterns in stock prices for momentum reversal that at least suggest that you might be able to make money using past prices. In this session, I want to look at technical analysis. Broadly speaking, technical analysis is built on using past price patterns to predict future prices. Increasingly, as we will see, trading volume has become part of technical analysis as well. So let's get the show on the road. If you look at the basis for technical analysis, here are the things that stand out. Technical analysts believe that price is determined solely by supply and demand. No, I wouldn't disagree with it. Everybody would agree with it. But technical analysts also believe that value is an abstraction, that markets are not focused on value, they're focused on mood and momentum and what shifts it. So technical analysis is all about forecasting supply and demand and argues that much of supply and demand might come from irrational forces that can cause stock prices to have the patterns that you actually observe. Detecting what that mood and momentum is and detecting shifts in that mood become the basis for almost all of technical analysis. With that lead in, let me make two confessions. The first is I'm not a chartist. I don't know enough about technical analysis to use it well, but I do know people who build their entire investing strategy, or let me put it differently, trading strategy around looking at charts and technical indicators. The second confession I'm going to make is there are hundreds and hundreds of these charting patterns and technical indicators, and I don't have the bandwidth or the knowledge to cover them all. Most of these chart patterns and technical indicators, though, come from making an assumption about human beings being irrational, investors being irrational, and that irrationality feeding into stock prices. So rather than try to cover all technical indicators, an impossible task, or go through them sequentially, I would like to bucket technical indicators into groups based on the behavioral assumption that drives the use of that technical indicator. I'm going to argue that almost all technical indicators fall into 5 buckets based on the irrationality that's at the basis for that pattern, for that indicator working. Let's start with the first one. We talked earlier about investor irrationality, and one of the things that stands out is maybe investors overreact to news, especially big news stories in either direction. What does that mean? When good news comes out, stock prices go up too much. When bad news comes out, stock prices drop too much. And if, in fact, investors overreact, here's what you should expect to see. Extreme movements in stock price in both directions should be followed by a drift in the opposite direction. You say, what are you talking about? If stock prices jump a lot, if investor overreaction is the rule that drives markets, you should expect to see prices come down in the weeks after. If the stock price drops a lot, you should expect to see stock prices drift up. And the more extreme the adjustment, the greater the adjustment, the initial drop or the initial increase, the greater the adjustment will be in the weeks following. Of course, you can push back and say, why, if this is the case, are there so few true contrarian investors in the market? We'll look at some reasons why they might not be. The second question, this is a more generic question about markets, is why are markets more efficient about incorporating some types of information than other types of information? With that lead in though, if investors overreact, there are some technical indicators and patterns that you can use to detect that overreaction. One is to look at odd lots. I know this is a throwback in time, but there was a time when if you bought 7 shares or 10 shares, you did not buy shares in round lots. Round lots were 100 shares, 1,000 shares. You paid more in transactions costs. It's a throwback in time because as trading has become easier, the odd lot trading effect has also dropped off. When odd lots were part of the game, there were analysts or investors who looked at the proportion of trading that was coming from odd lot, and here's the leap they made. Odd lot trading comes from small investors. Small investors, at least in their telling, are more likely to overreact and do rational things. So if a significant amount of odd lot trading is in the form of buys, you're going to sell the stock. If a significant of odd lot trading is sells, you're going to buy the stock. You're pushing against whatever the conventional wisdom is. The second indicator looks at institutional investors because institutional investors can also be irrational. Here you look at cash positions held by mutual funds. Most mutual funds are required to invest in equities. That's all they're allowed to do. They can go long on stocks, but they can't hold anything else. But what if you're a mutual fund manager, an equity mutual fund manager who believes stocks are overpriced? You know what mutual funds do? They hold cash then. And the argument that technical analysts would make is when mutual funds hold a lot of cash, they're being bearish about the future. But here again, you have to think like a contrarian. If you assume that mutual funds are generally wrong, they overreact, when they get bearish, you get bullish. So you basically buy shares when mutual fund cash positions rise, and you sell shares when they drop below what a typical or a norm is. The third is investment advisory opinion. Again, over time, investment advisors can be bullish or bearish. And if you're a contrary, if you believe that investors overreact, here's what you're going to do. As investment advisors become more bullish, they tell you that stocks are going to go up, you turn more bearish. You do the opposite. The assumption again is investment advisors are overreaching. They overreact to whatever is happening in the market. So the first group of technical indicators are built on the presumption that investors overreact, and essentially to give you the tools to detect when that happens and to act in the opposite direction. Take the second group of indicators. The second group of indicators goes to the core of the mood and momentum argument. The argument here is that stock prices go up and down, but they're driven by mood and momentum more than fundamentals. So your job as a trader then is to detect what that mood is, but more critically, detect when the mood is shifting. So there are a whole host of indicators that try to detect when mood shifts happen. So let's take a look at a few of them. One is the breadth of the market. What is the breadth of the market? On any given day, when you look at what the market did that day, you're going to see the market was up or the market was down. But if you take a closer look, sometimes markets can be up because a few stocks went up a lot. In other words, it's not as if the bulk of stocks went up, but only 30% of stocks went up, but they went up by enough that the overall market went up. That's a market with no breadth. In contrast, if you have a market advance, but most stocks go up, you have a market with breadth. You're saying, who cares? In the mood shifting world of technical analysis, when you have a market with no breadth, even if it's going up, you have to take the opposite position. A market with no breadth in either direction has no conviction. If no conviction, you view it as an advance indicator that the mood is going to shift. The second is support and resistance lines. As long as charts have been around, these have been around. And I'll show you a picture in the next, in a couple of minutes. But basically, this argument, the argument support and resistance lines, if you take a stock or even the overall market, there's an upper bound for prices and a lower bound. You're saying, how do you come up with the upper and the lower bound? By looking at history. If you hit the upper bound, the assumption is you're going to come back down. If you hit the lower bound, that you're going to come back up. But once in a while, you might break through the line. What does that mean? You go through the upper bound and keep going up. That is viewed as a mood shift, potentially. And here's where the contradiction comes in. For some traders, that could be a bullish sign. We'll talk about the argument for that. And for other traders, it can be a bearish sign. The third group of technical indicators are moving averages. Technical analysts love moving averages. They smooth out prices. What is a moving average price? Rather than look on day to day what stock prices are doing, you look at a 60-day average for prices. And you look at what the current price is and whether it's above the moving average line or below the moving average line. Again, how you view it will depend on what you think is an indicator of a mood shift, and you base it on that. And finally, you look at trading volume shifts. In addition to prices changing, trading volume can change over time. So if you have an extended period where trading volume is low, you might view it as a signal of a potential mood shift coming. So let's take support and resistance lines. By itself, if you look rationally, you're saying, who cares whether a stock breaks through a $100 price or $120 or $50? So basically, from a rational perspective, there is no basis for support or resistance lines. But let me give you a spin where they could potentially feed back and affect prices. I call this a price feedback loop. I'll tell you a positive story. where you break through the resistance line. You break through the resistance line. The positive story is you're going to draw in fresh investors with FOMO, fear of missing out, and that will push the stock price up. So there are some people who argue that when a stock price breaks through a resistance line, it is in fact going to continue to go up. At the same time, there are other traders who view exactly the same event and say, that's not good. If you break through the resistance lines, people are going to pay attention to you, and people pay attention to you. That's a bad thing if you're an overpriced stock, and your stock price will come down. One of the things you're going to notice about technical indicators, the same indicator can send different signals to different traders depending on how they view that indicator. The third group of technical indicators that I'm going to talk about are indicators that I call momentum indicators. At the basis for these indicators is the assumption that investors take time to learn. What does that mean? When good news comes out, the price might go up, but it won't go up enough because investors are still learning, and prices will then continue to go up in the weeks after. So this is the exact opposite of the investors, overreact story, but investors learn slowly. Conversely, if there's bad news, the price drops, but it's not done. It will continue to drift down. There is some evidence, and we'll talk more about this, that there are drifts after good news and bad news announcements. So the story can point to that evidence and say, look, it's true. But let's look at the indicators that you might use if you believe that investors learn slowly. Perhaps one of the most widely used technical indicators is relative strength. Sounds complicated, but here's what you do in relative strength. You take the current price and divide by the price 6 months ago or a year ago, depending on the period over which you want to measure the relative strength. That ratio of current price to price 6 months ago then becomes your measure of relative strength. The higher that number, the more momentum there is in the stock. The lower that number, the more negative the number, you're getting momentum in the other direction. So here's what a momentum indicator would suggest you do, that you buy stocks with high relative strength that have gone up the most. A variant on relative strength is to look at trend lines, where you draw a chart and you draw a line through the chart. If it's upward sloping, you got a stock with positive momentum. If it's downward sloping, you got a stock with negative momentum. Again, the period over which this chart is drawn can vary across traders, leading to the same stock having a positive trend line with one trader because they looked at the last 6 months, and a negative trend line for another trader who's been looking over the last 2 years. But relative strength and trend lines are momentum indicators, and increasingly momentum indicators are supplemented with trading volume analysis. Here's the reason, and this is a chart we looked at earlier in this class. It's a chart that looks at how strong momentum is as a function of trading volume, and it finds that the higher the trading volume, the greater the momentum effect. So by bringing trading volume into your technical analysis, you're strengthening your momentum story. So investors overreact, investors learn slowly. Contrary views of the world, but it's completely okay. And you could argue that both have some evidence out there to back them up. And the third, of course, is detecting shifts in demand and supply through looking at charts and looking at trading volume. The fourth group of technical indicators are indicators built around the presumption that some investors are smarter than other investors. It's built on the presumption that there is smart money out there. Who goes into the smart money pile? Might be hedge funds, in some cases might be names, Warren Buffett or Peter Lynch. And what do? You try to track what they do, and then you try to follow them. So it's a flip side of the contrarian approach, where you did the opposite of what institutional investors were doing. Here you focus on a subset of those investors because you think they're smart, and you try to learn what they're doing, and you try to do the same thing. So let's look at some indicators that have been around that track smart investors. One is specialists. This is a throwback in time again when trading happened on the floor of the exchange, and you had specialists who basically specialized in individual stocks. They managed the trading in that stock. The argument was that those specialists knew more about what was coming to the stock than the rest of us. So the people who track what specialists did, especially if they sold short on a stock, and then they would argue they must know that something bad's happening and try to imitate them. We'll talk more about insider buying and selling later in this class, but insiders are directors, managers. You could argue they know more about the company than the rest of us. So if they're buying, that's good news. You follow them and you buy as well. And if they're selling, it's bad news and you sell as well. Increasing with social media and with the amount of information we have, we can track what smart investors are buying, selling, holding. There are entire set of indicators, that track what Warren Buffett has been buying, even though the man is 93 years old, and you try to buy the same things. Implicit in all of these indicators is the assumption of smart money and trying to track what smart money is doing. The final group of technical indicators I'm going to put under a category that might sound like, that I'm trying to set it aside, but I'm not. These indicators believe that markets are controlled by external forces that are outside our control. And I'm going to call them mystics. So you will see these technical indicators where you'll see charts over not just a year or 2 years, but over hundreds of years. And the argument here is markets go through these waves that stretch over time, and there's nothing you can do to fight them. One is called the Elliott wave, which, where you look at markets over centuries and you argue that these waves have been around forever and they will come back to drive what prices do. There's also the Dow theory, where the market is always considered as having three movements, all happening at the same time. There's a narrow movement day to day, there's short swings month to month, and the third is a movement that stretches over years, and much of this is out of your control. Fighting it is futile. You basically have to go along. All in all, technical indicators stretch the spectrum because they're built around different assumptions about irrationality. So, as I said, there are people out there who build their entire trading/investing around technical indicators. Who am I to say that they don't work? But if you decide to go this route and use technical analysis and charting, I have 5 suggestions. First is find out the behavior or come up with it on your own. You might not be able to find it somewhere out there, but you can reason through it. What is the irrationality, the behavioral quirk on which this technical indicator is built? What are you trying to take advantage of? Second, when somebody tells you that a charting or a technical indicator works, just don't trust them. Verify it. Take a look at the data. It's actually very difficult to trust hazy patterns or very, very complex patterns. But some of the simpler patterns, like support and resistance lines, you can use the data to see if it actually works. The third is, even if you find a technical indicator that works for you, you need to trade on a timely basis. This is not the kind of trading where you can find a buy based on a technical indicator and wait a week to buy it. You got to buy it instantaneously. Execution is key, and keeping your trading costs down while you execute in a timely way is a tough trick to pull off, but you got to pull it off. The fourth is, and you probably noticed as we've talked about price patterns, is price patterns are very time sensitive. What does that mean? You got momentum over 6 months. You got reversal over 5 years. You have to have a time horizon that's almost Goldilocks in the sense that you got the right time horizon for the indicator you pick. You overhold or you underhold, you won't make the money. And fifth, when you're a trader, you are going to have a lot of trading. Over the course of the year, you might trade 3, 4, 5 times your portfolio because you're buying and selling almost on a continuous basis. It is key, at the risk of stating the obvious, that you keep a control on your trading costs. So you got to think about, what we talked about in the context of trading costs, bid-ask spreads, price impact, the cost of waiting, and weigh them all in and find a way to keep them under control. And if you can do that and make money on charts and technical indicators, all the more power to you. I hope you found this session useful, and I thank you very much for listening.